So now we want to look at what happened with OPEC, what is happening with this gas to oil switching, how much of that is possible. And we really want to look at that physical market versus the futures market, because there's a tale of two cities, if you will, when you start looking at some of the different backdrops. And one of the things that we've been really highlighting is just the amount of refined products that's in the market. And you're seeing a lot of that come over into the Atlantic Basin. And this is, I think, a great chart from Vortexa showing the Asia's exports of jet and diesel to Europe surge in September and continue into October. So this isn't something that is just, it's still going, it's still coming through. And when you look at just what is coming from Asia the other way, you can see this. I think the steady step up in just levels or thousands of barrels a day coming into the European markets, and we see that continuing into October. The question is there going to be enough demand in Asia to kind of lock out and close that arb? You know, since the things that we've seen since mid-September, because remember in mid-September we were talking about how Pakistan, Bangladesh really saw this big increase in high sulfur fuel oil demand. And now we've actually seen that drop off pretty considerably. And again, there's timing in that, there's price in that, but that is also seen a drop, which is pushed down some of that high sulfur fuel oil pricing. And then when you look at Singapore, there's still a lot of ultra low sulfur and very low sulfur fuel oil sitting in the water, kind of waiting to see where the best price is. Now, when you look at India, if you remember last week and the week before, we were talking about how refinery run rates were being cut, and you were seeing a bigger pivot away from diesel into gasoline just because there's such a glut of diesel. Now, how does that going to adjust when you look at the providing for an additional gas to fuel oil switching? So some of that can't be done just because they don't have that capacity. And then when you look at the monsoon season was actually very normal, which just means that the hydro dams that in the last couple of years have relied a bit more on backup gen, which was diesel powered, are going to be able to rely purely on the flow through of water. So that's going to essentially move some of that down. And then in the economy show, we're going to talk about how the rural economy has come under a bit of pressure, which is just going to limit the normal activity, because as you come out of the monsoon season, you see that tick up in diesel, which again is very seasonal. It's seasonally normal. So the fact that refiners are cutting diesel production ahead of that is just kind of giving you an idea of how much diesel they have in storage, especially when you look at the amount of exports that have gone into the market. So combined exports of diesel and jet from Asia to Europe surged to a 17-month high in September, with the bulk of supply flowing from India. Shipments were at 457,000 barrels a day last month, 16% higher month over month, and more than 50% exports were from India. Flows could remain robust through 4Q, although increased supply from the U.S. and Russia could limit Asia exports in the region. We don't see U.S. exports increasing. We do see Russia exports increasing, and again, like if there is not a pure Bond villain in this world, if there is, it's Putin, because Putin is just like, I picture him petting this like creepy cat and sitting there laughing at the absurdity of what's happening in this market, because they have the ability right now that, you know, Gazprom is increasing. He's come out and said that they will make sure to feed the pipes going into Ukraine, going into Europe, and you saw natural gas prices come off hard because of it. Again, he probably got short natural gas and then made the comments knowing what was going to happen. But you're also seeing an increase in the amount of diesel coming into the market, and an increase in the amount of oil, because there is a lot of pressure within the Russian economy. Things aren't going well. You've had another increase in COVID cases, which again is just keeping things slow. So that's allowing more to get pushed into the open market. You know, when you look at Fujairah, which we'll go through in a minute, you're seeing, again, another increase in heavy fuel. And that's going to be the one to watch. As we've been talking about, heavy distillate and residual are going to be the two kind of focal points as to how much of this gas to diesel or oil shifts are we actually seeing. And then when you look at overall exports last month from Asia to the US and Africa, dropped 24% and 21% month over month. Flows to the US were at 181,000 barrels a day, while those to Africa were 246,000. So a lot of those exports have really been more of an arbitrage coming into the U.S. are really coming from the European theater. Now, when we talked about OPEC, if you remember, our view was that OPEC was going to do nothing. And by do nothing, I mean just increase their normal 400,000 barrels a day. But you were going to get a cut in OSPs. And some of the cut in official selling prices were bigger for some regions versus others. And my view was that if you look at the physical market, there's no need for an additional 200,000 barrels a day. What there is a need for is margin and trying to incentivize some of these grades to move. And the only way you can do that is by incentivizing the refiners to take more. So by cutting that OSP, cutting that official selling price, you pass some of that down to the refiner, helping out. So here's where you look at where some of the discounts are. These discounts are for Saudi Arabia because this is kind of that bellwether that we were waiting for. The discounts increased a decent amount coming into the Mediterranean and Northwest Europe, which I think begs the question of why. And it's when you look at Europe, that is where you have a decent amount of fuel oil still consumed, especially in the southern countries and really Italy for the most part, Italy, Spain, some of these others but Euro prices have come under pressure again. You have Libya prices coming under pressure again. So they're trying to compete against that, where you have another cut into the US, but more importantly, especially on light, into Asia from $1.70 to $1.30 premium, which is going to be something to watch to see how much does it go a little bit further below that. And where do we kind of sit as we go forward, as Glencore offers Fortes for mid-October loading at a lower differential than even on Tuesday. So if you remember, we were talking about how there's a significant amount of September crude still available in the North Sea. We've seen that in the loading schedules. We've seen that in the floating cargoes, and you're seeing again that pressure continue to call through. But just putting some of these cuts in perspective, I think it's always important to see where are we versus historics. And when you look at the Middle East Arab Light cut to Northwest Europe, even though it's below 2020, you can see that we normally get a cut right now. It's still above where we have been previously. So you're seeing some of this movement. You're seeing some of this, I guess, signaling, but it's really not more than normal. So there isn't too much to get excited about. And then when you look at on the Asia side, it is a little bit of a deeper cut, which I think is indicative of what they're trying to pass on. So even though they're signaling they're trying to do more in Europe, they're not doing as much as they could. But when you look at Asia, it's now below 2019 and 2018 pricing, or I should say, just in terms of averages, which will, again, push through and help some of these Asian nations. More importantly, when you look at Singapore, and we'll look at some of those refinery spikes on those crack spreads. So now when you think about where some of these shifts are, the movements of foreign product coming from Asia and the Middle East into the Atlantic Basin is keeping our exports fairly capped. Gasoline continues to be under pressure, and when you look at just where things are coming from, the ARB is still a little open coming from Europe into the U.S., starting to close. We have a slowdown in demand in Latin America. So again, you're seeing a lot of these headwinds really start to ramp up when you look at gasoline, so that brought exports down 321,000 barrels a day. We will get a jump, but it's just going to be a very muted jump. And then when you look at distillate again fell by another 152,000 barrels a day, which is what we were expecting. And we just expect it to stay depressed, just given the amount of product coming into the market. While, as we were saying last week, propane had a nice bounce. LPG was up 328,000 barrels a day, well above the 5-year average. And then when we were looking at crude exports, they actually dropped 906,000 barrels a day. We were expecting it to drop down to about 2.6, so about a 400,000 barrel a day drop. But you're still seeing, again, those pressure points that continue to come through. Now, European imports of clean petroleum product from East Asia this month may climb to the highest since October, according to. So right now, there's about another cargoes of about 400,000 tons, and the full month could be about 480,000 tons. So European imports of clean product from East Asia are set to hit their highest since last October. So again, it's increasing. Typically, October, you get a big month, but the fact that it continues to come up and the arrivals in October could be even higher, just given where things are versus September, is going to keep our DISTI fairly capped. And then when we talk about U.S. exports, we're now well over $4 to some of the most expensive versus Dubai we've been. Well, you can see we've had some spikes down in 2018, 2019, and now we're having this double dip in, and this is just going to keep U.S. exports fairly firm, and just you're going to see that get stuck in pad 3, which is what we've been talking about. And the same can be said when you look at Brent, seeing the very similar elevated levels, not as steep. It's very steep now, but there's been other points in time, which is why those cuts on the different OSPs, you're starting to see some of these offers come down to try to incentivize, where even though Brent-DUBAI is sitting here, you can buy it for cheaper to try to keep these cargoes moving, because the futures market is showing one thing and the physical market is struggling. And one of the things that we like to look at is when you look at LNG, each new incremental cargo is trading for more money, where when you look at each incremental physical crude cargo is trading for equal or less. And that's when you're looking at the difference in the amount of available capacity in the market, which again is deviating from some of the commentary. Now, the question always comes back to, well, how much gas to oil switching is going to happen? And the question comes down to, well, how cold is the winter going to be? Are we going to have a cold winter? Are we going to have a warm winter? Are we going to have a normal winter? And how much of this fuel oil capacity is still in existence? Because remember, there's been a big push on the green side to retire some of it, take it out of capacity. So we've taken down coal. We've switched the coal or fuel oil to natural gas. And is there some of that pivot back and forth? How much of it is dual fuel versus singular? And those questions remain to be seen. Could we get 250 to 300,000 barrels a day of additional demand? The answer is yes. I'm not quite sure it's a million, but again, these are just some of the things that we're going to continue to look at as we go forward, and the pressure continues to mount. But the fact that natural gas prices have come down, Henry Hub is now down 62 cents, still at 570, not saying it's cheap, but when you just look at where some of the prices are, there's going to be a lot of competition to see where some of this plays out, especially given some of the slowdowns we've seen in high sulfur fuel oil demand. So now when we look at gasoline exports, you can see that there was a big drop. We still expected to go to kind of move along that 5-year average. But as we were saying last week, we expected to be below the 5-year average, but within the kind of the belly of the cloud on the lower end, and we still see that coming through as some of these catch up, and we do have that elevated amount of not only just blending components, but also gasoline sitting in storage. Then when you look at distillate, as we were saying, we expected it just to come back down and then just go sideways. So depending on where we sit, it could fall within the cloud, it could be just below. We just think that there's a lot of headwinds, and it's multi-based. One, there's a lot of competition in the floating market, but there's also a big shortfall in U.S. storage. So why export it if you're going to make just as good, if not better, money in the U.S., especially when you look at diesel prices at $3.47 in the U.S. on the national average and going higher, especially when you look at where heating oil demand is going to be just on normal heating oil. We don't even need to be this extreme to see a lot of these exports remain trapped. Ethane exports, this doesn't update as much. We saw this, we did see this spike. It didn't come back to the highs that we had in 2021, but we will see this be elevated and at the top end of the range. When you look at crude oil exports, you had that big drop. Nothing crazy, as anyone who knows us. We've been saying 2.6 to 2.8 million barrels a day on average, and here we are. So nothing crazy, because when you look at it, we're at over the 4-week rolling average, we're at 2.642 million barrels a day of export. That's going to continue. South Korea did just purchase 2 million barrels for January delivery. So again, you're getting kind of that base, as we've been saying, of that 1.8 million barrels a day that's always purchased. And then that delta is just based on pricing, which continues to deteriorate versus the global market. And then when you look at propane exports, right back to the highs, nothing crazy there. When you look at crude in the ARA, you can see that there was a small decline, very nominal. One of the things that we do see this spiking back up, especially when you look at floating storage and the amount of crude that is flagging from the Middle East and West Africa, that is flagging not only just the US, but also Europe. So we do expect this to work its way back up to that 7-year average. And now when you look at just what is sitting in storage, you can see that there was a small build in gasoline and naphtha, a small build in gas oil, a small drop in fuel oil. But one of the things that we've been talking about the most in Europe is fuel oil and gas oil, because right now fuel oil is at a near all-time high and gas oil is just off the all-time lows. And this is going to be very important when you look at what type of demand is and how much of this pivoting can you get from gas, from renewables into oil burn. So this is where we expect more increases, more imports. We're still going to be well off of that 13-year average, but you're going to see it creep back up. And especially right now, just given where weather is, you're coming into kind of that lower period or the shoulder season. And I think you're going to see some of these guys start to panic a bit and start to bring some of this back in, moving us back up to that average. While on the gasoline side, as we've been saying, we expect it just to go sideways. On the 7-year average, on the 13-year average, you can see that there's normally a draw. We just expect this to go sideways to slightly up, just because you're starting to see a slowdown in gasoline demand. Again, nothing more than seasonal. And the target remains disty, or that diesel side. So you're going to see gasoline kind of get thrown off, just because when you make diesel, you inherently make gasoline. So that will, again, keep some of this moving higher. And the same can be said in the US. As you increase your production of diesel, you inherently create gasoline. The question is what type and what quality of gasoline is always going to be kind of a moving target, depending on how heavy the crude is and what kind of process you use. So this is why we do see this creeping higher. Now on the fuel oil side, as we were saying, we expect this just to go sideways, but this was something that was getting recracked, and now it's going to be interesting to watch because it's elevated. There's a lot of there's some flexibility in this fuel oil inventory, which could help kind of dampen the amount of new demand that we're going to see. Because again, the question is always how much oil demand will be created by a cold winter. But the question should be asked a little bit differently. At what point does storage in these get to such a point that we see that reaction on the refining side? You're already starting to see some preparation for it. So you are starting to see some of those additional runs, but we still have a decent amount of product in storage that will have to be utilized first before we start to see a much bigger reaction in general. And then when we start looking at the loading schedules, you can see that things still remain elevated in general. Russia's still at a high. You have Norway at 1.67, 1.68. You have Nigeria that is staying with more additional condi coming through, more so than oil. Angola's seeing that elevated levels, with Libya sitting at about that 1.17. But when you look at the top, you can see that we're kind of holding at about that 11.2, 11.3 level as we go through October into November. And one of the things that we're going to look at is what are some of the things trading for in general. So when we look at West Africa's oil has been selling slowly, yet you have to consider that China is currently in Golden Week. So with with China in Golden Week, that's going to slow down some of those purchases. We saw some acceleration in September. in anticipation of Golden Week. As we've talked about, there is an increase in the amount of cargoes signaling China. Those were purchased at the end of September. Now we're starting to see some of that come through. The issue is now that the Middle East and more specifically Saudi Arabia has cut some of those pricing, do you get the full allotment coming from the Middle East? And then that is going to put pressure or additional pressure on West African cargoes. And that's going to be the important piece to watch as we progress through the rest of October. Nigeria is yet to sell about 30 to 35 cargoes scheduled for loading through the end of the month. The tally includes mostly November cargoes as well as some October, and that's concerning as we go forward because we're already in October, and October should have already been sold. So then the question becomes, do you start to see some deferrals where November goes back up, October comes down, because we keep seeing some of these kick to the right, but they have cut their OSPs to try to incentivize that. So they could do it again now that Saudi has taken it down to increase some of that flow into the US and Europe. Nigeria is due to load about 53 cargoes next month. Angola has yet to sell 15 cargoes out of 33, which is actually quite slow, and that's a slower pace than this time last month. And remember, last month was right in line with the 6-month average, but the 6-month average is much slower versus the historical average. So this is slower than even slow. So I get an idea of kind of where things sit on the Angolan side. And that's a slower pace than this time last month when 7 to 8 shipments were outstanding from 38 planned. So again, out of 33, we have 15. So even though they've taken down their cargoes, they still can't sell, which again points to some of those bigger issues. Euro cargoes for October are proving slow to clear due to a sizable program because they increased their program in general. Urals cargo for first half of October loading from the Baltic have yet to be sold out, partly because the October loading program is the biggest in 18 months. And they also face additional competition, not only from Libya, but now also from medium sour grades from Iraq, which is also creating some of this overhang, which then begs the question, why is Iraq selling so much into this region, when you look at where the boats are coming from, there's a decent amount coming from Iraq and the Kuwait, UAE into the US and European markets. And then the arbitrage to Asia or the US remains closed, depending on, on the Urals side, which again is just keeping less Urals coming into the US, pretty much none going to Asia, and pushing it into the European theater. And then CPC blend are very limited as most October cargoes are sold, which is also providing some of that adjustment. And then the November loadings should come out this Friday. Now, CPC has gotten a bit better, and then at the same time, ESPO still remains strong. So ESPO, which is coming out of Russia, is trading at about a 17 to 19-month high, depending on which cargo number we take. Or price, we should say. So realistically, it's a matter of grades, and that's where we're seeing some of this friction. It's the quality of crude that is dictating what kind of premium it gets. While the North Sea has a good grade, but further away, you're seeing essentially very little demand as the Middle East and West Africa try to get more competitive in the market. But even with some of the tightness, CPC blend crude to BP was at $2.60 less than dated Brent, which was weakens from $1.75. So again, you're seeing some of that weakness remain in the system, and the same can be said for Urals as well. So as we look at that UN World Tourism, you can see that for 2021 continues to be a challenge for global tourism as volumes remain. In July, we're still 67% lower versus pre-pandemic. And looking ahead, the rest of the year remains mixed, with 53% of panel of experts surveyed expecting worse off versus previous. So again, you're kind of getting some of these shifts. And then when you look at India's refiners and petchems issued a tender to sell 65,000 metric tons of diesel for loading from the new Mangalore over November 1st to 3rd. So you're still seeing, again, India is still trying to increase these exports, still trying to push more out, which just begs to, how much of this tightness do we really have in the market in general? And then stock of heavy resid rose by 1.452 million barrels to 8.176 million. This is a reversal of last week's fall of only 256,000 barrels. The fuel oil market has been seeing some demand weakness since the second half of September, as high sulfur fuel oil demand from South Asia declined after that peak summer season. And that's what, given you still see prices, you still see LNG very expensive. So the question is, how much of this is going to come through? And you're just seeing that slowdown in the general demand with Bangladesh, with Pakistan and buying interest from Pakistan and Bangladesh weakened as electricity demand tapered off. Bangladesh projected its high sulfur fuel oil imports for October would fall 10 to 15% on the month to total around 340 to 360,000 metric tons. Platts reported previously, Chinese demand for Singapore marine fuel was seen weak on October 5th, as traders said China is buying less bunker fuel even though it is producing less. So you're seeing, again, some of these shifts where China's weakness continues to accelerate, and that's a big talk that we're going to focus on in the Econ show. And now when we look at Singapore fuel oil, you can see that there's a big drop from 45.4 to 41.1, and that was pretty much all driven by resid and light disti, which we'll talk about in a second. So here, when you look at that big drop, we're now back to the 15-year average, but we want to go through the specifics. So when you look at the Singapore residual, this is the one that we wanted to watch, and here you can see that big drop. Now, we expect to see a spike, but not to the peak that we were at, but really closer to kind of that small little increase that we had a week ago. And it's just going to be that timing of when is it released, and I think you're going to start to see more of this show up, especially as we come into a bit of that slow period on a seasonal basis. Now, light distillate finally had a move down after being so elevated, but you can see it's just right at the lows for 2021. And as we've been saying, we expect it just to go sideways and have that kind of chevron pattern. And this is just that low point. We expect to see a build, not quite taking back, but based on what we're seeing, it'll probably take back about half of this move down over the next week. And then when you look at middle distillate, as we were saying, we expect to be below the 15-year average and kind of stay below, just because we do have some of that competing demand. But now when we look at crude oil in transit, you can see that crude oil in transit is starting to creep back up. We expect it to get back to that 5-year average because we are seeing that acceleration of purchases now that we've had OSP cuts, and you're seeing some of that competition increase in the physical market. You will see that oil in transit pick back up. As we continue to see, in general, the amount of oil floating in storage, again, back to that 2021 high that we've seen over the last few months. Now, when you look at crude oil on the water, we're right at the 5-year average, and it's really because we have oil in transit picking back up. But really, right now, it's oil in floating storage that continues to make up this lion's share, and we're just not working through it, because we do have those issues at the port, which is, again, pulling down more than really it should be on the onshore side, because they're just struggling to get that space, to get that timing, to get crude essentially off the water and into onshore. So you really have to look at the two of them together to get that full picture. Then when you look at Brent time spreads, you had the contract roll-off, so in December, January, you can see things are coming down a bit. Still elevated, still high, still a lot of bids within the time spread, but you're starting to see some of that softness come back through. And obviously, it's coming. It's pulling this down a bit. While Brent December versus December continues to be at near essentially 2-year highs when you look at the overall spread, as the expectations continue that you're going to get that additional benefit in 22 versus 21. So you're seeing some of that spread continue to get priced back in. We don't expect too much softness. Right now there's still that narrative push when you look at that pent-up demand. What is international travel going to look like? What is fuel to oil switching, gas to oil switching going to look like? Which again is keeping that very well situated. Now you have distillate, you have resid, and now you have the OSPs. So you have that really nice spike in these refinery margins. You do have an increase in natural gas prices. You do have an increase in hydrogen prices. So the underlying profitability is still a bit muted, but you're seeing a lot of this starting to get made up for based on how DISTI is pricing and how OSPs are being passed through, which is where you're seeing that nice spike, which again, that OSP cut should accelerate and should pull some of these additional physical barrels into the refiner and enable them to make some profit while increasing the amount of product in storage waiting for this winter period. And this is just giving you an idea that the huge ramp up that we had on the hydrocracking side. So hydrocracking, again, using hydrogen. So the hydrogen costs have gone up. Obviously, natural gas costs have come up, which are an input cost for a refiner. So some of that has to get made up, and that OSP cut coming through has really enabled that and helped that significantly. So then when you look at the Ural side, it's coming down across the board. Now you're firmly in the positive territory, so you're going to see those Urals come through, trying to, again, compete as Ural prices have continued to come down. As we've been saying, that when you look versus Singapore, you've had a very steady increase in margin, and that is now getting the extra benefit from that OSP cut. And the same can be said in the Mediterranean now, especially when you have additional competition from Iraq, Saudi Arabia, Libya, and Russia that are really competing, which again is going to increase the overall, because even the ones, the topping side, all of these that have been below zero are now firmly above in the positive territory, as the China supertanker crude imports continue to track right around the 5-year average, and they're going to continue to move in the essentially elevated direction, but very much along seasonal lines. Even as we continue to see a reduction in refinery throughput. They're down to and following 2018 levels right now. They're at about 68%. The same can be said for the state-owned guys. There's a very kind of steady move down. This is a mixture, because when you look at 2018, you have that drop. When you look at 2019, you have that drop. And hint, hint, it's Golden Week, so you normally have that. The question is going to be, what do we look like on the other side of Golden Week, given the amount of product that still remains in onshore storage? Asian floating storage, right back to the highs, as we were saying it was going to be, and by the highs, right back to kind of where we were prior to the typhoon. And we do expect this to continue to increase. When you look at the amount of crude that is slated to show up, that is going to continue to keep this very elevated versus historics. When you look at North Sea, you had a nice drop, and that's because you did get that big, as we talked about, Fortes, drop some of these the OSPs. You're trying to start to see some of these move. We're right back to the 5-year average. We think we're going to stay above that 5-year, just as, again, that elevated level continues to remain through, and they continue to issue some of these price cuts. But again, that's still going to keep us above that 5-year. While West Africa has curled over a bit, now we're going to start to see that build back up, as Angola and Nigeria are talking about a much slower selling so far. So, and again, it's going to be timing delay. When does China come back? How much do they buy after Golden Week? Regardless, we're going to stay above the 5-year average, but realistically, we're going to move back to the seasonally adjusted highs. Now, when you look at the Middle East, you can see that we're still elevated versus, obviously, now there's 2016 and 2017. We're still right around where we were in 2017. And when you look at the amount of exports that are coming, exports continue to increase. Even though production hasn't done much, you've seen that decent increase in exports. And now you're seeing a little bit of an elevated amount of crude and floating storage, and we expect that to continue to creep higher. Europe, as we were saying, we expect this just kind of hug the 5-year average with not too much to change in general. Now, when you look at Shandong crude, you can see that we're still at seasonally adjusted near all-time highs. Obviously, 2020 was higher, but we're still very much above where we have been throughout the last 7 years, and that doesn't seem to, we don't see that changing anytime soon. Now, fuel oil is something that we've been talking about extensively. They continue to kind of sit on it, waiting for what is demand going to look like internally, what is that going to mean in general, while, here we expect to see this fuel oil stock remain elevated as China prepares for, not only just recracking, but how much of this oil will be burned for power generation. So that's all we have for you today. If you have any questions, again, you can find me on Twitter at MarkFNY, or you in the comment section, or again on email at mrossano at c6capitalholdings.com. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.